First speaker is going to be Michael McGill. Michael teaches financial economics and general equilibrium theory in the college. Following him is going to be Professor Yong Kim. Yong is a macroeconomist and also an expert on what's going on in the housing market. And batting cleanup is going to be Professor Robert Dickel. Robert is also a macroeconomist and is an expert on what's happened in Japan, where they had a 15-year economic malaise, which hopefully we'll manage to avoid. So, Michael, do you want to take it away?
The government has been trying to make housing available to a very large segment of the population, which is, remember what Adam Smith said years ago, since there are economists here, do-gooders rarely do good. And the good intentions of the government actually have translated into a fiasco. So basically what they did was they even insisted that banks had to get involved in local investment to help the poorer neighborhoods invest in housing, which is fine, but it just depends on how you do it and how much you do. So let's get straight right away where some of the blame lies. They want to blame it on Wall Street, but actually you should go straight back to Congress and say, look, you guys, you've been a big part of the problem. And you know, when you get a big storm, it doesn't come from nowhere. It takes a long time to gather momentum. And this thing, an event of this magnitude, has taken many years to accumulate. To further turbo the process, real markets for mortgages, Wall Street was full of innovations and decided, well, we've got a cool way of dealing with this. We'll package these amorphous things into groups of pooled securities. And we'll ship them out to Wall Street and we'll handle this stuff in a nice way. Now, you have to understand the theory helps you quite a lot very often. Innovation is fine, but innovation sometimes comes with other problems associated with it. In particular, economists understand something called moral hazard. I mean, the key thing, which is you broke the relationship between the originators and the people who are going to be taking the risks. So basically what happened was that you started offering mortgages to anybody in town who would sign on the dotted line. You didn't ask embarrassing questions about their income or anything about their credit. In fact, you just gave a mortgage to anybody who wanted to step up on the plate. So, consequences, you get borrowers who are much less qualified. Now, an important consequence is now that the demand for housing increases. So prices start to rise. At the time, it so happened that interest rates were getting credit anyway very favorable. And so you have a further, if you like, increase in demand. And so these are all the classic ingredients for a speculative bubble. Real part, financial part. The guys, MBS, mortgage-backed securities, arrive on Wall Street. Welcome to part two. Turbo in every direction. They package these objects and overlay, yes? By the way, the rating agencies are temporarily asleep and using past evidence for payoff rates to evaluate your securities. You get a bursting bubble and higher delinquency. So obviously, when the bubble starts to burst, then without going into details, a lot of the people who bought these things on the expectation the prices were going to rise now find themselves in a much riskier position. And so the whole process starts to come to an end. This just says to people who understand theory that the normal theory just doesn't work for these kind of instruments. By the way, one of the problems in this whole process is that a lot of the trading in the securities that we're talking about here were done over the counter, OTC. And so there were no organized exchanges on which a lot of this stuff was going on.
And you can see that before 1995, the fluctuation in the house price was not very dramatic, and its trend was pretty clearly defined. Since 95, you have this meteoric rise in the real house price, which peaked, as I said, in the fourth quarter of 2006. Now, when you're trying to think about the reasons why this house price went up, one of the reasons you might think of is that the demand for housing services, which you can get when you own a home, improved. So you might think that you know, there's more people and the land is fixed, or you might think people are richer, and that's why the price of housing went up. Well, to filter out those reasons, you can look at the real rent index. So the BLS publishes a rent index that controls for differences in the quality of rental units, and then combine that with the CPI to look at how the price of renting a unit of housing services changed over time, and that's the pink line. And you can see that the movement in that hasn't been very dramatic, especially during this housing boom and bust. And now the rent price ratio is going down, so the expectations are getting weaker and weaker. Now, so I would say that's the prevailing view amongst a lot of economists, and the basis by which people are making forecasts for where the house price is going to go is based on this ratio being restored to its level before 1995. Okay? The timing of how long it's going to take to get there is typically not mentioned, but if you look at forecasts by financial companies, that's essentially what they're doing. Now, as students, you should question any theory you come across, and one of the things you might want to question is that, okay, under this story, we're saying that the expectations of the house price right now, second quarter of 2008, are just as optimistic as the expectations in 06. So that's what these guys are saying. Either that, or that there's some reason why the house price takes a long time to adjust.
I'm going to talk a little more broadly about the consequences of the financial, so-called financial crisis. So there has been a credit crisis. Every day, it's the difference between the LIBOR, or the London Interbank Offer Rate, which apparently sets credit cards and auto loan rates and commercial borrowing and prime business borrowing. The spread between that and the federal funds rate, in normal times, it's about 225 basis points, right? But during last week, it went up to about 425 basis points. Today, it's down to about 200. So people take that as evidence that lending among banks has really declined, or banks are very cautious about lending to each other. And if banks are cautious about lending to each other, banks are allegedly cautious about lending to Main Street or to General Motors and your corner grocery store and restaurants. And that's the so-called credit crunch or credit crisis. So there's some economists that have went and tried to calculate in a very simple way at some investment banks. Those that still have jobs at investment banks said that so GDP will be lower than the credit crunch. This is before the bailout, but I don't know if they really expected the bailout or not, but the tightening of credit would result in US GDP growth lower than 2% than otherwise, over 2 years. So the next 2 years, 2009 and 2010, GDP growth would be 2% lower. So 2% of US GDP is about $280 billion extra loss in GDP due to the financial system. But even without the financial crisis, we would have had a recession, I think, anyway. Michael started out by saying, hey, Wall Street's not to blame, but toward the end, he was really railing against Wall Street. So I think he and I are on the same page on this. That, of course, we should not bail out all finance institutions, including regional banks, hedge funds, and insurance companies. Because what that means is that the upside risk, they get the upside risk, but the downside risks are socialized, right? So a common thing with, I don't know, this sort of more lefty-oriented analysts would say, capitalism is the privatization of gains and the socialization of losses, right, of the too big to fail banks. And it's not untrue. I mean, I was working at the Federal Reserve Bank of New York in 2006 and 2007, and I talked a lot with hedge fund people and investment bankers, and their view was Well, if they issue asset-backed securities against real estate or land or housing and write derivative contracts or credit default contracts against these, they're going to be bailed out because Congress and the US government's going to look after Main Street and look after the poor homeowner. So we're covered on the down end so we can go crazy and try to gamble on this. And this has been, they didn't say this directly as I did, but it's something that was commonly known among the smart money people on Wall Street.